Good morning to all of you. Before starting new topic in economics, again same chapter number 9, national income. Before starting new topic, first of all, once again try to understand three different methods for calculating national income. First one is income method. Second one is production method. And third one is expenditure method. The three methods are there for calculating national income. Production method is also known as output method or value added method. Now first of all, income method. What are the components of income methods for calculating national income? And national income means NNPFC, means net national product or national income, both are same. The net national product at factor cost. So in NNPFC, three different terms are included. One is net, then national product, and then factor cost, NNPFC. Now income method. First of all, income method, which items we are including in income method? One is rent, means all types of factor income. Factor income means the amount which we are paying to different factors of production, land, labor, capital, entrepreneur. Whatever amount we are paying to these factors of production against their services, that is called factor income. So rent. Second one is interest. Third one is wages. Fourth one is profit. And fifth term that is not given in your textbook, that is called mixed income. Mixed income. So after adding these five terms, you will get N, means net. Here why we are taking net directly, not taking gross? Because here we are calculating or including only incomes. Here production does not take place, we are making payment. That's why net. Gross, when gross comes? When we are using production method or expenditure method. Reason, when we are producing goods, then machineries and various other fixed assets are used. That's why their value decreases at the end of the year. But when first time, when whatever value we are getting, that is called gross, because depreciation means loss value is also included in that amount. Expenditure method, why gross is used? Because we all know that whenever we are purchasing goods, any particular goods, we are paying price of the product including tax. And whenever tax is included, that's why market price as well as gross is included. Gross means depreciation value is included. But so far as income is concerned, in income method, gross is not included. So net, we will get net domestic product, and because these are factor income, that's why it is called factor cost. In short, NDPFC. Now after adding these five components, we get net domestic product at factor cost, means NDPFC. Now we have to convert this NDPFC into NNPFC. So we need to add plus net factor income from abroad. Means in short it is called NFIA. Net factor income from abroad. After adding net factor income from abroad, we will get net. After adding NFIA, domestic product is converted into national product. Net national product at factor cost, means in short it is called NNPFC. So this way we can calculate national income by income method. First of all, rent plus interest plus wages plus profit plus mixed income is called NDPFC. NDPFC, when we add net factor income from abroad in NDPFC, it becomes NNP at FC, means national income at by income method. First method is completed. Now production method. In production method, we will take the monetary value of goods and services produced by, because this production method produced by all the three sectors. So in one line I am writing, otherwise you have to write 3 times. Value of goods produced by, here I am taking all sectors. Here amount is given. Value of goods produced by all sectors. Here means you have to write 3 times. The value of goods produced by primary sector, value of goods produced by secondary sector, value of goods produced by service sector. Then you have to make total of these 3 items. It is equal to, when you add the goods produced by all sector, then it is called gross value of output at market price. Gross value of output at market price. Now from this, in this term, first of all we have to calculate, take the value of goods produced by different sectors. Goods produced by primary sectors, goods produced by secondary sectors, goods produced by tertiary sector, means service sector. After adding the goods or services produced by all these 3 sectors, then that value is called gross value of output at market price. Here 3 different terms are there: gross, then value of output, then market price. Now one by one you have to convert this gross value of output and market price into NNPFC. This is national income. Now first of all gross means it includes depreciation. That's why it is called gross. Value of output means it includes intermediate goods. So first of all, less intermediate goods. Less the value of intermediate goods used by all sectors. Less value of intermediate goods used by all sectors. When you deduct the value of intermediate goods from value of output, then it becomes domestic product or value added. So after deducting intermediate goods used by all sector, we will get gross domestic product at market price. In short, it is called GDPMP. Now gross is written, we have to convert this gross, means G, into N. So we need to deduct depreciation less depreciation. Once you deduct depreciation, you will get net. Then domestic product remains same. Domestic product market price at market price means NDPMP. Now it becomes NDPMP. Last one is MP, market price. Market price means it includes net indirect tax. So we need to deduct net indirect tax less net indirect tax. Net indirect tax formula is indirect tax minus subsidy. Write down within bracket indirect tax minus subsidy. So after deducting net indirect tax, it becomes net remains same, net domestic product remains same, domestic product, but market price is converted into fixed cost. So it becomes net domestic product at factor cost, NDPFC. Here also we have got NDPFC. Now what we have to do to convert NDPFC into NNPFC? We need to add net factor income from abroad. So last point is plus net factor income from abroad. Net factor income from abroad. When we add net factor income from abroad, finally we will get national income or NNPFC. Net national product at factor cost. This is the final answer. Now third method, that is expenditure method. In case of expenditure method, first of all we need to take private final consumption expenditure, private final consumption expenditure. Private final consumption expenditure means the amount spent by household, families on purchasing various types of goods and services. Then second component, this first one, second one is government final consumption expenditure. Government is also spending lots of money on infrastructural facilities, and they are also making payment in the form of salary, wages to their employees. So government final consumption expenditure. Third one is investment expenditure. Investment expenditure means the private sectors, the businessman, the industrialists who are spending money on the establishment of industry, on purchasing raw material, on making payment of salary to their employees. Such type of expenditure is called investment expenditure. Fourth one is net export expenditure. Many industrialists are such which are exporting goods to other countries or importing goods from other countries. So whatever money is spent on importing or exporting such goods, that is called net export. Difference of export minus import, net export expenditure. And here within bracket I am writing export minus import, X minus M. X means export, M means import. After adding all these expenditure, expenses, after adding these four expenditure, it becomes gross domestic product at market price. Now why we are getting gross domestic product at market price? Because here we are talking about consumption expenditure. It means, for example, here investment expenditure, we are taking example of investment expenditure. When we are producing goods, in order to produce goods, we need to use various types of fixed assets, and whatever fixed assets we are using for production, the value of those fixed assets also reduces at the end of the year, and that is called depreciation. But after adding this expenditure, whatever value we are getting, it shows that we have not deducted depreciation. So gross is written here. Domestic product, because these expenditure are incurred by the individual within the geographical boundary of the same country. Why market price is written here? Because when we are purchasing any goods or services, we need to make payment in the form of price. That price also includes tax. That's why it is called market price. Now one by one we have to deduct or add such terms which brings national income, means NNPFC. Now which term first of all we have to deduct? Here gross is written. We need to convert gross into net. So less depreciation. Less depreciation. Less depreciation. After deducting depreciation, we will get gross is converted into net. Net domestic product at market price. Net domestic product at market price. Now gross is converted into net, domestic product remains domestic product. Now market price, we have to convert market price into factor cost. How? Now less net indirect tax after deducting net indirect tax. And then what is the formula for net indirect tax? Indirect tax, in short I am writing here IT, means indirect tax minus subsidy. So less net indirect tax. Once we deduct net indirect tax, we will get net domestic product at factor cost, NDPFC. NDPFC. And once we get NDPFC, only one item here, NDPFC, this is also NDPFC. Now we need to convert NDPFC into NNPFC, means N is same NN. Now here FC, only difference is NP and DP. Here DP is given. So we need to convert DP into NP. So which item we need to add? Plus net factor income from abroad. Net factor income from abroad. And after adding net factor income from abroad, finally we get national income, means net national income at factor cost, means NNPFC. In this way, by these three methods, we can calculate national income. These are the three methods: income method, production method, expenditure method. In case of income method, rent plus interest plus wages plus profit plus mixed income is equal to NDPFC. And after adding net factor income from abroad, we will get NNPFC, net national product at factor cost. Production method, which is also known as output method or value added method. Here first of all, value of goods produced by primary sector, value of goods or services produced by secondary sector, and third, value of goods produced by service sector or services provided by service sector. After adding all these amounts, we will get gross value of output at market price. Then deduct or add different terms one by one. First of all, we need to convert gross, so deduct depreciation, then value of output, deduct intermediate goods, market price is given, deduct net indirect tax. When you deduct these three different terms, then we will get NDPFC. And once you get NDPFC, in all the three methods, only one item you need to add, net factor income from abroad. And after adding net factor income from abroad, you will get national income, means net national product at factor cost. Similarly, in expenditure method, four items are there, four different types of expenditures are there: private final consumption expenditure, then government final consumption expenditure, investment expenditure, and net export expenditure. After adding all these four expenditure, we will get gross domestic product at market price. Again, deduct depreciation, deduct net indirect tax, we will get NDPFC. And once NDPFC we get, then we need to add only one item, net factor income from abroad. Means by these three methods we can calculate national income. Then next These are three different questions. Explain the income method for calculating national income. Explain production method for calculating national income. Explain expenditure method for calculating national income. In that, you have to first of all you have to write this format, this formula, and then explain one by one. First of all, we are adding in paragraph. First of all, we are adding rent, interest, wages, profit and mixed income. After adding all these components, we get net domestic product at factor cost. Then after that, we need to add net factor income from abroad. Then we get net national product at factor cost or NNP-FC. In this way, you have to explain. In the same way, in production method, first of all, you have to write formula. Then you have to explain all the points in paragraph, in points. For example, first of all, according to production method, we need to calculate the value of goods or services produced by all sectors. After adding the value of goods produced by all sector, we get gross value of output at market price. Then we need to deduct value of intermediate goods, value of depreciation, value of net indirect tax. After deducting all these three terms, we will get net domestic product at factor cost. And ultimately or finally, we need to add net factor income from abroad. We get national income or NNP-FC. In case of expenditure method, first of all, you have to write this formula and then convert this formula into points or paragraph. First of all, we need to add private final consumption expenditure, government final consumption expenditure, investment expenditure, net export expenditure. We will get gross domestic product at market price, and then we need to deduct depreciation and net indirect tax. We will get NDP-FC or net domestic product at factor cost, and ultimately when we add net factor income from abroad, we will get net national income or net national product at factor cost. Now second topic. 3 questions are there. 4th question we have already done. Which type of items or which type of transactions are not included in national income? So yesterday we have completed. Now today new topic is circular flow of money. How money circulates in an economy. Which items are not included in national income? Orally I am telling you. First one is any kind of transfer income. Transfer income means one-sided income. Any kind of transfer income is not included in national income. Income from illegal activities like smuggling, black marketing are not included in national income. Sale of any second-hand assets are not included in national income. But brokerage means commission earned by broker is included in national income. Then value of intermediate goods are not included in national income. These are the different types of transactions which are not included in national income. Now new topic is circular flow of money. Circular flow of money means how money circulates in an economy. This is a very extensive explanation, but in your textbook very short explanation is given. Before understanding about circular flow of money, you have to understand about the 2 types of economy. Total there are 2 types of economy. One is closed economy. And other is open economy. Nowadays closed economy does not exist. Only open economy is there. Now what is closed economy? Closed economy means when any economy, any country does not have any trade relation with any other country. When any particular country does not have any trade relation, they are not importing goods, not exporting goods with other countries. So whenever any economy does not have any kind of trade relation with any other trade relation, diplomatic relations with any other country, then such type of economy is called closed economy. Means neither they are providing any kind of help to other countries, nor they are taking any kind of assistance or help from other countries. Such economy is called closed economy. Open economy where economy, one particular country has a trade relation, political relation, diplomatic relations with the other countries, then such economy is called open economy. So nowadays open economy exists. Now in your textbook, how money circulates in an economy, explanation is given about closed economy, which does not exist nowadays. Closed economy is not there. In whole world, each and every country is depend on other country for different types of goods and services. That's why closed economy does not exist, but explanation is given only about closed economy. That's why I am also explaining about closed economy. Once again, definition of closed economy. Closed economy are those economy in which one particular country did not have any relation, trade relation, political relation with other country, means neither they are importing goods nor they are exporting goods. Such economy is called closed economy. So how money circulates in closed economy? In closed economy, we are assuming that total there are two parties. One is firm, F-I-R-M, firm, and other is household. Household or families or owner of factors of production. The two parties are there, household or families or owner of factors of production. Here firm means business units or industrialist. Now first of all, these household families are providing services to firm, They are providing various factors of production like land, labor, capital and entrepreneur. So this unit is providing different types of factors of production to firm. Against that, firm is making payment to household in the form of rent, interest, wages and profit. So here household has provided factors of production to firm. Here rent, interest, wages, profit is paid by firm to these different factors of production. Now here money flows from firm to household. Now after receiving money by household or families, then firm is, when they are getting factors of production, they are able to produce goods. So now firms are producing goods and providing to or supplying to household. So they are supplying goods and services to household. Goods and services. First of all, firm has taken the services of different types of factors of production. With the help of those factors of production, they are producing goods. And because they have taken the services of factors of production, that's why they are making payment in the form of rent, interest, wages and profit to household. Now whatever money received by household families, such families will spend money on purchase of goods and services. So goods and services are provided by firm to household. In return, they are getting money, means payment of goods and services. So first of all, money flows from firm to household. Then money again, after receiving money received by household, now they are shifting that money, supplying that money to firm firm is paying rent, interest, wages, profit for taking factors of production. Then household is paying or making payment of goods and services which they had purchased. Here purchase of goods and services. This is called circular flow of money. In case of this is an example of closed economy. Closed economy. Practically it does not exist. So in case of closed economy, first of all, closed economies are those economies where one particular country, one particular economy does not have any relation with any other country. Means they are neither importing goods or exporting goods from other countries. Now how money circulates in closed economy? Because closed economy is there, means other countries does not involve, so only two parties are there, firm and household or families or owner of factors of production. Now how money circulates? First of all, they are providing services, they are providing factors of production to firm. In return, firm is making payment. So first of all, money flows from firm to household. Then with the help of this factor of production, whatever goods and services produced by firm, they are supplying those goods and services to household. In return, households are making payment of those goods and services. Means money flows first of all from to household and then household to firm. This is called circular of money. So almost chapter is completed. So tomorrow we will try to touch each and every topic from textbook and this chapter will be completed.